These are some instructions to students and learners. Use headphone while listening to this lecture to have a clear and undisturbed listening. Please keep a notebook or paper and pen and a calculator to solve the problems alongside the process of viewing this video and also to note certain points. Students are advised to solve different problems from reference or textbooks on this subject based on this learning process because only practice can make you perfect with the concept. In case of any queries, students can contact on WhatsApp mobile number given in this video. Hi students, let us take up for discussion today the cost of capital topic. Let's try to first understand what this cost refers to in financial management. Cost refers to the minimum rate of return expected by the investors. Basically, the cost of capital has a direct relation with the risk involved in the firm. That's why we say high risk is equals to high cost of capital and low risk is equals to low cost of capital. Now the question comes up as to why do we study this particular topic, or what is the relevance of understanding the cost of capital, because all of us know that capital is not free and it's at a cost which the companies have to bear when they raise from a particular source of fund. So let's try to understand the significance of this particular study. The first significance is that it helps in capital budgeting. That is, in understanding the application of various sources of funds for different projects based upon the cost of the capital over here. Secondly, it helps in determining the capital mix. Now here, capital mix, as it has been understood earlier, that it's the composition of capital, namely the composition of equity, debt, and the preference capital over here. The cost of all these sources of finance are different over here, and thus a proper understanding of the cost of capital will help in determining the proper capital mix or an ideal capital mix for an organization. Third, it also acts as a base for determining the financial performance of an organization over here, because this helps us to understand the cost effectiveness that a company has tried to maintain in designing its capital mix so that the cost of the overall capital is kept at the minimum over here. Now let's look into the classification of costs. Costs generally have been classified based on the behavior of costs. So the first classification that we find is it's classified into historical costs and future costs. Now historical costs are costs which are based on the past period of time, or generally what we say that the costs that have been incurred. And we also feel, and it's been found that there are certain costs which are incurred in the past act as a base in understanding the behavior of cost, and at the same time, and another concept is that of the future costs over here, where we try to take into consideration the behavior of costs in future over here. The second classification is the specific cost and the composite cost over here. Now when we say specific cost, we refer to here understanding the cost of capital of a specific source of fund over here. For example, the cost of equity, in specific, the cost of debt, the cost of preference capital, or the cost of retained earnings over here. Whereas composite cost refers to the overall cost of capital that the company has raised over here, wherein we can also call it as an average cost of capital over here. The third classification is as average cost and marginal cost over here. Now, as we said, in case of an average cost, we try to calculate the arithmetical average cost of all the sources of finance over here. Whereas marginal cost refers to the cost of an additional unit of fund that is raised. Marginal cost speaks about the additional cost of capital that is incurred in raising an additional unit of fund. Now, though these classifications give us a brief idea about the very characteristics or the behavior of costs, generally, the specific cost and the composite costs are calculated in order to understand the specific behavior of cost. Now, when we say average cost, we also calculate the mathematical average. It's like a finding out by adding up all the specific costs of capital and finding an arithmetical average of it. Whereas there is another method wherein we try to calculate the weighted average cost of capital also, where specific weights are given to the different sources of capital. We will discuss this particular point at a later stage. Now, another point that has to be noted over here is that ascertaining this cost of capital is also not an easy task. There are some problems that we face. Now, let's try to understand what are the problems in determining the cost of capital. Now, the first problem that we generally face is that the controversies regarding relationship between cost of capital and capital structure. Now, many experts have an argument that there is a some believe that there's a relationship between cost of capital and capital structure, who feel that it's the cost of capital that decides the capital structure of an organization over here. Because every organization tries to keep the cost of its capital at the minimum level to be more cost effective in capital raising. But at the same time, there are experts who believe that there is no relationship between cost of capital and capital structure. Now, who are of the viewpoint that it is the availability of capital at a particular point of time which matters more, and the other factors that would influence the capital mix over here. Thus, there exists a slight controversy in this particular relationship, which acts as an hindrance in determination of cost. Two, there's always been a contradiction between considering the historic cost for certain cases along with the future cost assessments over here. Now, this contradiction also exists amongst the experts in this area of financial management. Some believe that whereas the cost behavior in the past may be the same in future also. So, the historic costs would be of greater relevance over here. But at the same time, some feel that the future is unpredictable, uncertain, and it may not have any relevance with the cost that existed in the past over here. Even this argument holds good in the present changing scenario or the environment, which is very volatile, uncertain. Therefore, this acts as another problem in determining the cost of capital. The third problem is in computing the cost of equity capital. We all know that equity capital refers to the owner's capital, and these equity shareholders, though they are not guaranteed a fixed rate of dividend on the amount of capital invested, but these shareholders expect a return on their capital and also expect a growth in their capital over a period of time. The residual earnings of an organization belong entirely to the cost of equity capital. So here, the return on equity capital is never fixed, it fluctuates, and thus the expectation of these equity shareholders is not like that of the expectation of the debenture holders or the preference shareholders over here. Thus, because of this growth expected return by the shareholders, there appears to be a slight problem in computing the precise cost of equity capital for a company. Fourth, there's a problem in computing the cost of retained earnings. Now, retained earnings generally refer to the undistributed profits held by a company over a period of time over here. Now, it's an internal source of finance that a company has with it over here. Now, when a company intends to use this particular source to fund its capital requirements over here, now calculating the cost of such internal source is slightly a difficult one because this fund belongs to once again the equity shareholders only. Now, the same problems that are faced in computing the cost of equity capital applies even to the cost of retained earnings over there. Let's also consider the fifth point. That's the problem of assigning weights to different costs of different sources to determine weighted average cost of capital. We should know that when we try to calculate the weighted average cost of capital, weights have to be assigned to the different sources. Now, weights refer here to the proportion of a specific source of capital bears to the total amount of capital of the company over here. When we calculate this weighted average cost of capital, when we assign these weights, now these weights can be assigned either on the basis of the book value of the source of capital or on the market value of the sources of capital. Now here we have to understand that the book values do not change, but the market values would definitely undergo a change over here, especially in case of the equity share capital over here. That's why we find that there is always a slight difficulty in considering whether the book values have to be taken, or the market value of the source of finance should be taken when we assign weights while calculating the weighted average cost of capital over here. Let's now try to understand what are the different ways in which the cost of capital can be computed over here. Now, generally, the cost of capital can be computed in two different ways. The first one is calculating the cost of specific source of capital over here. Now, when we say specific source of capital, we mean we try to calculate the cost of a specific source. For example, cost of equity, cost of debt, cost of preference share capital, or cost of retained earnings in specific. The second method that we have is calculating the weighted average cost of capital. Now, this is what we mean the manner in which an overall average cost of capital is calculated, where weights are assigned to the specific source. Let's start to understand how the computation of specific source or specific source of capital is undertaken over here. Let's take up first for discussion the computation of cost of debt. Now we should know that the debt capital is a borrowed capital and carries a specific rate of interest payable to the investor, which is decided at the time of issue of the debentures. The interest payable on debt is an allowable expenditure. Therefore, it helps the company in savings tax. Thus, the cost of capital is calculated in two different ways, namely cost of debt before tax and cost of debt after tax. Now, when we say cost of debt before tax, we try to calculate the cost of debt without considering the tax factor or the benefit of tax that the company would get because of the debit of interest to the profit and loss account over here. Here, we would definitely find that the cost of debt would be slightly on a higher side in comparison to the cost of debt after tax, because when we calculate the cost of debt after tax, we consider the tax factor and the benefit of the debit of interest is seen in the savings in tax for the company. Now let's try to understand the formula for calculating the cost of debt before tax. Now the formula generally is written as KDB is equals to I upon P, where K stands for cost, the underscore D represents the debt, and B before tax over here. The capital I indicates the interest on debt that's payable, and P is the principal amount of debt that is being raised. Let's look into the formula for calculating the cost of debt after tax. Now, here the formula or the equation is written as K underscore DA is equals to KDB 1 minus the 1 minus T, we say, where K stands for cost, underscore D for debt, A after tax, and T is the tax percentage over here. Now we should also know that the debentures at the time of issue are either issued at par, premium, or discount. Thus, the net proceeds should be considered while calculating the cost of debt. Due to this factor, the formula for calculating the cost of debt undergoes a change. Namely, KDB is equals to I upon NP, where NP stands for the net proceeds realized at the time of issue of debentures. Let us now try to calculate the cost of debt for a given problem so that we understand the computation of cost of debt in a very specific manner. Let's take for example, a company has issued 10% debentures for an amount of rupees 5 lakh. The company is in a tax bracket of say 50%. Calculate the cost of debt before tax and after tax when A. The debentures are issued at par, B. The debentures are issued at a premium of 10%, and C. The debentures are issued at 10%. Let's now take the first case where the debentures are issued at par. And calculate the cost of debt before tax. Now let's write the formula first, that is KDB is equals to I upon P. Now let's put the values over here. Now KDB is equals to 50,000, that's the interest, and 5 lakh rupees is the proceeds at par, multiplied by 100 to convert it into a percentage over here. So when we substitute the figures, we get KDB is equals to 10% over here. Now you can find here that the cost of debt before tax when the debentures are issued at par, the rate of interest as well as the cost of debt appears to be the same over here. Now let's look into computing the cost of debt after tax. Now the formula is KDA is equals to KDB 1 minus T into 100. Now let's put up the relevant figures over here. Now KDB as calculated is 10%, that is 0.10, into bracket 1 minus tax rate. Now the tax rate is 50%, therefore it's written as 0.50. Now when we substitute this, the cost of debt after tax is equals to 5% over here. Now we can very well understand from this that the benefit of tax that a company enjoys because interest on debt is an allowable expense is seen very clearly over here, because the cost of debt before tax appeared to be at 10%, and when the tax factor is considered, the cost of capital reduces to 5% over here. Let us now take the second case where the debentures are issued at premium of 10%. Let's calculate first the cost of debt before tax. Now once again we write the formula KDB is equals to I upon NP. Now let's put up the figures here. KDB is equals to 50,000 divided by 5,50,000. So here the par value is 5 lakh and 10% premium means that's 50,000, totaling to 5,50,000 is the net proceeds over here, multiplied by 100. So we get the percentage, that is 9.09%. Now you can very well make out over here, when the debentures are issued at a premium of 10%, the cost of capital gets reduced from 10% interest that's payable 9.09%. Now this fall in the cost below 10% is basically because we are receiving a larger amount in comparison to the debt that we have accepted. Now let's look into the calculation of cost of debt after tax over here. let's put up the formula. KDA is equals to KDB 1 minus the tax rate into 100. Yeah. Now let's put up the figures. KDA is equals to 0.09, 1 minus the tax rate, that is 0.50 into 100. So we get the cost, that is 4.55%. Here also we can see how the tax benefit enjoyed by the company because of interest being an allowable expense is visibly seen, because the cost of debt before tax is 9.09%, whereas the cost of debt after tax is 4.5. Let's now take the third case where the debentures are issued at a discount of 10% over here. Now, first let's calculate the cost of debt before tax. We write the formula KDB is equals to I upon NP. Now, when we put it in the figures, KDB is equals to 50,000 divided by 4,50,000 into 100. Now, if you look here, the net proceeds reduces by 50,000 because the issue of these debentures is at a discount of 10%. Now, KDB is equals to 11.11%. So, what do we find? That the cost of debt when debentures are issued at a discount of 10%, the cost is much more than the interest percentage over here. That is, it crosses 10% and it shows at 11.11% over here. Let's look into the computation of cost of debt after tax. Now we write the formula KDA is equals to KDB 1 minus the tax rate into 100. Now we put in the figures. KDB is equals to 0.11 into bracket 1 minus 0.50 into 100. So KDA is equals to 4.55%. After noting how to calculate the cost of debt before tax and after tax at different issue prices, let us also note that debentures are issued as redeemable or irredeemable. In case if debentures are redeemable after a specific time period, then the cost of debt of such debentures is calculated with the help of following equation. KDB is equals to I plus 1 upon N into bracket MV minus NP divided by half of into bracket MV plus NP, where I stands for interest, N for number of years, MV refers to the proceeds on redemption of those debentures, NP represents the net proceeds at the time of issue. Now let us take an example to practice the same. For example, a company issues 12% debentures of rupees 6 lakh at par, redeemable after 5 years at par. The company is in a tax bracket of 40%. Calculate the cost of redeemable debt. Now let's put up the formula over here. KDB is equals to I plus 1 upon N into bracket MV minus NP close the bracket divided by half of into bracket MV plus NP close the bracket into 100 to convert it into percentage. Now let's put up the figures here. Now the interest on debentures at 12% is 72,000 rupees plus 1 upon 5. Now 5 here indicates the period after which the debentures are redeemed into bracket the maturity value, that's 6 lakh rupees because the debentures are repayable or redeemable at par, minus the net proceeds, that is 6 lakh rupees because the debentures are also issued at par, divided by half of 6 lakh plus 6 lakh into 100. Now that gets us 72,000 divided by half of 12 lakh rupees. That's equals to 72,000 divided by 6 lakh into 100, which gives us the cost of debt before tax to 12%. Now let's calculate the cost of debt after tax for this particular debentures. That's KDA is equals to KDB 1 minus the tax rate. Now we put in the figures. So cost of debt before taxes 12%. So let's put up as 0.12 into 1 minus 0.40. That is the tax percentage 40% into 100. That gives us 7.2%. So we can see here how the after tax cost of debt reduces to 7.2% because of the tax benefit. Now let us take an example when issue of debentures are at a premium and redemption at par. So for example, a company issues 10% debentures of rupees 5 lakh at premium of 10%, redeemable after 5 years at par. The company is in a tax bracket of 40%. Calculate the cost of redeemable debt. Now, KDB is equals to I plus 1 upon N into bracket MV minus NP divided by half of maturity value, that is MV plus NP into 100. Now, KDB is equals to 50,000. Now 10% interest on debentures of rupees 5 lakh works out to 50,000 rupees plus 1 upon 5. 5 represents here the period of redemption into bracket the maturity value 5 lakh rupees, that is it's redeemed at par, minus 5 lakh 50,000. So here the net proceeds is 5 lakh 50,000. That's 50,000 more because the debentures are issued at a premium of 10% divided by half of 5 lakh plus 5 lakh 50,000 into 100. Now that gives us 50,000 minus 10,000, because we have to understand that 5 lakh minus 5 lakh 50,000 gives us minus 50,000. So 1/5 of minus 50,000 is minus 10,000 divided by half of 10 lakh 50,000 into 100. So KDB is equals to 40,000 divided by 5 lakh 25,000 into 100. Now that gives us the cost before tax at 7.62%. Now KDA is equals to KDB 1 minus the tax. So the KDB is 7.62% written as 0.0762 into bracket 1 minus 0.40 into 100, which gives us an after tax cost of debt at 4.7%, which also shows here that it's much lesser than the cost of debt before tax because of the tax benefit that the company enjoys. Let's now take another example when issue of debentures is at par and redemption at premium. For example, a company issues 8% debentures of rupees 4 lakh at par, redeemable after 5 years at a premium of 10%. And the company is in a tax bracket of 40%. Calculate the cost of redeemable debt. So once again we write the formula. KDB is equals to I plus 1 upon N into bracket MV minus NP close the bracket divided by half of into bracket MV plus NP close the bracket into 100. Now when we put in the figures, now interest is 8% on 4 lakh rupees, that's 32,000 plus 1 upon 5 into bracket 4 lakh 40,000, because the maturity value is at a premium of 10%. Therefore, the figure would be 4,40,000 minus 4 lakhs divided by half of 4,40,000 plus 4 lakhs into 100. So we get the figures 32,000 plus 8,000 divided by half of 8,40,000 into 100. That gives us 40,000 divided by 4,20,000 into 100, which gives us a cost of 9.52%. Now the cost of debt after tax would be calculated as KDB 1 minus the tax rate, that is 0.0952 into bracket 1 minus 0.40 into 100, which gives us a cost of 5.71%. Let's now take up the study of computation of cost of preference share capital. We all know that preference share capital is issued by companies to raise capital, and these shares carry a fixed rate of dividend. They are also issued at par, premium, or at a discount. These preference shares may also be of the class of redeemable in nature. So now let us understand how to calculate the cost of preference shares. First, when preference shares are issued at par, the following equation is used to calculate the cost. That is, K underscore P is equals to D upon P, where K stands for cost, P preference shares, D represents dividend, and P the proceeds. Second, when preference shares are issued at par or discount, the following equation is to calculate the cost. KP is equals to D divided by NP, where NP stands for net proceeds. Let us now try to calculate the cost of preference share capital for the following example. A company issues 6% preference shares of rupees 3 lakh. Calculate the cost of preference shares when the shares are issued at par, B at premium of 10%, and C at discount of 10%. Let's take the first case. When preference shares are issued at par. So we write the formula K underscore P is equals to D divided by P. Now when we put the figures, so the dividend is 18,000, that's 6% on 3 lakh rupees, divided by the net proceeds at par, that is 3 lakh into 100. So we get the cost KP is equals to 6%. Now we can see here the rate of dividend and the cost is the same because the preference shares are issued at par. Now let's go to the second one, when preference shares are issued at premium of 10%. Now we write the formula K underscore P is equals to dividend divided by net proceeds over here. So we put the figure 18,000 divided by 3,30,000 into 100. So we get the cost as 5.46%. Now we see a reduction in the cost basically because the shares have been issued at a premium of 10%, where we realize 30,000 rupees more than the par value of the shares, whereby it indicates that we are receiving a larger amount in comparison to the amount of debt, an amount of par value of 3 lakh rupees, which is a debt towards the preference shareholders. Now let's take the third one, when preference shares are issued at a discount of 10%. KP is equals to dividend upon net proceeds. KP is equals to 18,000 divided by 2,70,000 into 100. Now you can see here that the net proceeds has reduced to 2,70,000 from 3 lakh rupees. Because of the 10% discount, we receive less at the time of issue. So the cost of preference capital here increases to 6.67%. Now all these examples will tell us how the cost of preference share capital would undergo a change when these shares are issued either at par, premium or discount. As we earlier said that even the preference shares are redeemable after a specific period either at par or premium. In such case, the cost of preference share capital is calculated with the help of following formula. KPR is equals to D plus 1 upon N into bracket MV minus NP close the bracket divided by half of into bracket MV plus NP close the bracket into 100%, where R is equals to redeemable preferences, N is equals to number of years, MV is equals to maturity value, and NP is equals to net proceeds. Now let us take an example to calculate the cost of redeemable preference shares for the following. For example, a company issues 5% preference shares of rupees 5 lakh issued at par and redeemable after 5 years at par. So here issue is also at par and redemption is also at par. Now let's put on the formula quickly. KPR is equals to dividend plus 1 upon n into bracket MV minus NP close the bracket divided by half of into bracket MV plus NP close the bracket into 100. Now when we put the figures, now the dividend is 25,000 plus 1 upon 5 representing the number of years after which it would be redeemed into bracket 5 lakh minus 5 lakh close the bracket divided by half of 5 lakh plus 5 lakh into 100. So this gives us KPR is equals to 25,000 divided by 5 lakh into 100. So the KPR is, let's now consider another example where redeemable preference shares are issued at premium and they are redeemable at par. For example, a company issues 6% preference shares of rupees 7 lakh issued at a premium of 5% and redeemable after 7 years at par. So the formula we write is KPR is equals to dividend plus 1 upon n into bracket MV minus NP close the bracket divided by half of into bracket MV plus NP into 100. So we put in the figures. So dividend, that's at 6%, 42,000 plus 1 upon 7 here. The redemption is after 7 years into bracket 7 lakh minus 7 lakh 35,000. Now here 7 lakh 35,000 is basically because of the 5% premium at which the debentures have been issued over here, divided by half of into bracket 7 lakh plus 7 lakh 35,000 into 100. So we get the figures 42,000 minus 5,000 divided by half of 14 lakh 35,000 into 100. Now we get here minus 5,000 basically because in the previous step there is 7 lakh minus 7 lakh 35,000. So that gives us a figure into bracket minus 35. So 1/7 of that represents minus 5,000 rupees divided by half of 14 lakh 35,000 into 100. So KPR is equals to 37,000 divided by 7 lakh 17,500 into 100. So that gives us a cost of 5.16% over here. So you can see how the cost of preference share capital reduces to 5.1. Let's try another example where redeemable preference shares are issued at par and redeemable at a premium. So for example, a company issues 8% preference shares of rupees 9 lakh issued at par and redeemable after 9 years at premium of 10%. So we write the formula as usual and we put in the figures over here. So dividend 72,000 plus 1 upon 9 into bracket 9,90,000 because the maturity is at premium, so 90,000 more is paid, so 9,90,000 minus 9 lakh divided by half of 9,90,000 plus 9 lakh into 100. Now that gives us 72,000 plus 10,000 divided by half of 18,90,000 into 100. That gets us through 82,000 divided by 9,45,000 into 100. So the cost is 8.68%. Now you can see very well over here that the cost of preference share capital is 8.68%, much higher than the dividend percentage. Now why does this increase? This is basically because the shares have been issued at par, but they are repayable at a premium of 10%. So your liability after 9 years is more than the amount that you have raised at the time of issue. After we have learned how to calculate the cost of debt and cost of preference share capital, let's now go to the process of understanding the computation of cost of equity share capital. As students of financial management, we all know that equity capital is considered as the owner's capital. The shareholders of equity participate in managing the affairs of the company as they carry voting rights. We should also note here the characteristics of equity shares. That is, they're not guaranteed with any dividend, but they have all rights over the residual profits. Thus, they have no fixed expectation of returns on their investment and also expect a growth in their dividends over a period of time. Moreover, the equity shareholders are much interested in the market value of the shares rather than the dividend. All this makes it difficult to calculate the cost of equity capital in a very specific manner. Thus, the cost of equity is calculated with different ways. The different methods of calculating the cost of equity can be studied as follows. First, dividend yield method, where we calculate it with the formula K underscore E is equals to dividend upon NP, where E is equals to equity, D is equals to dividend, and NP represents the net proceeds. Or when we consider the market price of shares, the equation undergoes a slight change where it's written as KE is equals to dividend upon market price. The second method for calculating the cost of equity share capital is dividend yield plus growth method, where the expected growth percentage by the equity shareholders is considered and the formula is written as KE is equals to dividend upon net proceeds plus the growth percentage. The third method is the earnings yield method, where the earnings per share are considered in calculating the cost of equity. So the formula is written as KE is equals to EPS. Let us now take an example to understand the calculation of cost of equity under different methods. For example, a company has issued 1 lakh shares of rupees 10 each at a premium of 20%. The company has declared a dividend of rupees 2 per share. Calculate the cost of equity under the following circumstances. A. When the market price of the share is rupees 25. B. When the growth in dividend is expected at 10%. C. When the EPS per share is rupees 4. Now let's first take up the calculation of cost of equity at net proceeds and market price. Now the shares have been issued at a premium of 20%. So each share will fetch us 2 rupees more. That is, the net proceeds will be 12 rupees per share. So here, let's put up the formula. KE is equals to dividend upon net proceeds into 100. And when we put up the figures, we get it as KE is equals to 2 divided by 12 into 100. That gives us the cost of equity as 16.67%. And when we calculate this at the market price of the share, which is standing at 25 rupees per share, so we get it as KE is equals to 2 upon 25 into 100. That gives us a cost of 8% over here. So at market price, the cost of equity is 8% over here, much lower than the cost of equity at net proceeds. Let's go to the option B, where the cost of calculating the cost of equity when the growth in dividend is expected at 10%. So we write the formula KE is equals to dividend divided by net proceeds plus the growth percentage into 100. So KE is equals to 2 divided by 12 plus 0.10, that's 10%, into 100. That gives us the cost at 26.67%. Now you should just see here how at net proceeds in the previous example the cost of equity was 16.67%. But here, when a growth in dividend is expected at 10%, the cost of equity goes up to 26.67%. Let's go to the third option, that is computing the cost of equity when the EPS per share is rupees 4. We write the equation KE is equals to EPS divided by net proceeds into 100. So KE is equals to 4 divided by 12 into 100. That gives us a cost of 33 point. Now we come to the last part of a specific source of fund. That's the computation of cost of retained earnings. Retained earnings are the accumulated profits or the undistributed profits which a company has accumulated over a period of time. Retained earnings are an internal source of funds to the company. Though these funds are available with the company, it does not mean that these funds are free of cost. As these funds belong to the equity shareholders, ascertaining the cost of these funds becomes essential. The cost of retained earnings is as good as the cost of equity, but as the company uses these funds by capitalizing the reserves, the company saves by way of dividend tax and the brokerage, which it otherwise would have been liable to pay if liberal dividends were declared and new capital had to be raised from the market respectively. Thus, the cost of retained earnings is calculated after considering the tax rate and the brokerage that otherwise would have. Now, the formula for calculating the cost of retained earnings is as below. So, KR is equals to KE into bracket 1 minus T, close the bracket, into bracket 1 minus B, where R represents retained earnings, T the tax rate, and B the brokerage percentage. Let's now try to calculate the cost with the help of the following example. Say for example, a company whose cost of equity capital is 8% and it intends to use the available retained earnings to fund its capital requirements. The company is in a tax bracket of 40% and the brokerage payable would be 2%. Calculate as to what would be the cost of retained earnings to the company. Now let's put up the formula here. KR is equals to KE 1 minus tax into 1 minus brokerage into 100. Now let's put up the figures here. So cost of equity is 8%, that is 0.08 into bracket 1 minus the tax percentage, that is 0.40, 1 minus the brokerage, that's 2%, that is 0.02 into 100. So that takes us through 0.08 into bracket 0.60 into 0.98 into 100, which gives us a cost of 4.70%. Now let's take us the study of calculation of weighted average cost of capital, the second method in calculating the cost of capital. Now the second method of calculating the cost is calculating the weighted average cost of capital, where a weighted average cost of various sources of finance is ascertained to know the average cost of capital to the company in helping to take capital mix decisions. The method adopted here is step 1. Proper weights, that is proportion to total capital, are assigned to each source of capital. In step 2, the after-tax cost of each source of finance is calculated. Step 3, the sum of the weights and the specific cost is calculated. And in step 4, the total of the weighted cost is divided by the total weights multiplied by 100 to convert it into percentage. So the formula goes as under: K underscore W is equals to summation XW divided by summation W, where W represents weighted average cost of capital. The calculation can be well understood with the help of the following example. For example, let's take a company which gives you certain details about the specific cost of the different sources of funds. So let's take this example. Following are the particulars of capital structure of Rajat Limited, where the equity share capital is raised and the specific cost after tax is 12%, and the book value of this source of finance is 2 lakh rupees. Preference capital is raised at a cost of 10% and the book value is 20,000 rupees, and debentures are raised at 8% at a book value of 30,000. Now we have to calculate the weighted average cost of capital using the book value weights. Now in order to calculate this, we just put up a chart with five different columns. The first column is the source of funds, the second column the amount of funds, third for the weights assigned, fourth the specific cost, and the fifth column, that's the sum of the weights into costs. Now let's put up the first figure, equity share capital. So the book value is 2 lakh, specific cost 12%, then preference capital 20,000, the specific cost 10%, debentures 30,000, the specific cost 8%. Now after we put up these two figures in these two columns, let's assign weights over here. Now the total of capital raised is 2,50,000. Now considering this as the base, we try to find the proportion of equity capital to the total capital. Now when we calculate that, it's 80% of the total capital. So we assign a weight to equity source as 80. Then we calculate the proportion of preference capital to the total capital, that is 20,000 to a total capital of 2,50,000, that is 8%. So the weight that is assigned to preference capital is 0.8. Similarly, for debentures, we calculate the proportion of 30,000 to 2,50,000, that's 12%. So we assign the weight as 12. Now the sum total of the weights will be always equals to 100 because it's calculated to a percent, 100. Now we multiply the weights and the cost. So in case of equity share, the weight 80 is multiplied to the specific cost of 12 to get a sum of 960. Similarly, the preference capital weight of 08 is multiplied to the cost specific, that is 10%, that is 10. So 8 into 10, 80, and for debentures 12 into 8, that is 96, which takes a total to 1136. Now let's put up the formula for calculating the weighted average cost. So KW is equals to summation XW divided by summation W. So when we put up the figures, summation XW, that is 1136 divided by 100, that gives us a percentage of 11.36%. So the weighted average cost of capital is 11.36%. Now let's take another example where, suppose for the same problem, if market value of the sources is also given. So following are the particulars of capital structure of Rajat Limited. Now here you would find that along with the book values, the market values of the specific source of capital is also given to you, and you are asked to calculate the weighted average cost of capital using market value weights. So once again we put up the same columns here. The first column is source of fund, second amount, third weights, fourth cost, and fifth the sum. Now we put up the first variable, that is equity share amount 80,000. Now here we are taking the market value as the base for calculating the weights. Preference capital 20,000, debentures 20,000, and the total is 1,20,000. Now we also put up the specific cost over there. Equity capital 12%, preference capital 10%, and debentures 8%. Now when we assign the weights, we calculate the proportion of 80,000 to 1,20,000, that is 66.67. Similarly, preference capital, it is 16.66, and debentures, it is 16.66, taking a total of weights to 100. Now when we multiply weights into specific cost, so we get the sum. For equity capital, it is 66.67 into 12, that is 800.04. For preference capital, it is 16.66 into 10, that is 166.60, and for debentures it is 16.66 into 08, that is 133.28, taking a total to a sum total or a grand total of 1099.92. Now let's put up the equation to calculate the weighted average cost of capital. So KW is equals to summation XW divided by summation W. When we put up the figures, we get KW is equals to 1099.92 divided by 100. That gives us a percentage of 10.99%, or approximately 11% over here. So in this problem, we try to understand that either the book value or the market value can be taken as weights to calculate the weighted average cost of capital. But when we take the book value, if it is higher than the market value, definitely we would find that the weighted average cost of capital would be on a higher side, whereas when the market values are less, as in this case, the overall cost of capital would definitely be on a lower side. There's another method of calculating the weighted average cost of capital. Let us try this for the previous problem, where the different sources of capital, their specific cost, book value, and market value are given, and we are asked to calculate the weighted average cost of capital using the market value weights. So let's put up the same columns once again. Sources of funds, amount, weights, cost, and sum. Now here a slight difference is adopted in calculation where the source of fund, the amount is put up, the weights are assigned, and in the cost column, it's not just the cost figure is taken, but it's taken as a cost percentage, as 12%. Similarly, for all the specific sources, these values are put up. Now, we calculate the specific cost in relation to the weights. For example, in case of equity share capital, the weight is 66.67 and the specific cost is 12%. So we calculate 12% of 66.67, which is equals to 8% over there. So we put up in the sum 8%. Similarly, we calculate 10% of 16.66, that is 1.666. And in the same way, for debentures, it is 8% of 16.66, which gives us 1.333. Now, when you total the sum column, you get a total of 10.999. Now, that's the weighted average cost of capital, that is 10.99% or approximately 11% over here. Now, this takes us through an understanding of calculating the cost of weighted average cost of capital and also the cost of specific source of capital. So, the very outcome of the discussion of this topic, cost of capital, is to understand how ascertaining the cost of capital is important for a company, because when it taps different sources of capital, it should know what are the specific costs of each source, and at the same time what is an average cost of capital for the company, so that it can take a decision on a proper capital mix.